Good afternoon, everyone. My name is Stamatis Tsantanis, and I am the Chairman and CEO of Seanergy Maritime Holdings. Together with me today is Mr. Stavros Gyftakis, our CFO, and we will be presenting you Seanergy Maritime Holdings. We're listed on the Nasdaq Stock Exchange under the ticker SHIP, SHIP. Moving on to the slide. The first slide of today's presentation. As I mentioned before, Seanergy is the only US-listed pure-play Capesize owner. For those of you that are not aware of the various vessel sizes, the Capesizes are basically the largest conventional size of dry bulk vessels. Our main commodities that we transport are iron ore and coal. These are right now the most important commodities for the production of steel and various other infrastructure investments that will take place and have been taking place in various parts of the world. We have been listed on the Nasdaq Stock Exchange since 2008 under the ticker SHIP. We have a modern and high-quality homogeneous fleet. All of our ships have been built in high-quality shipyards in South Korea and Japan. We have a very experienced management team. Solid corporate governance with no related party transactions, very strong commercial ties and partnerships with some of the world's largest miners and vessel operators. We will discuss that later today. And we have one of the lowest Capesize acquisition costs among the industry. So basically, Seanergy is in the best position to capture the dry bulk vessel upside that has already started and we expect it to continue in the next years. Moving on to the next slide, as you can see here, this is our fleet list, 11 high-quality Capesize vessels, very homogeneous fleet, quite low average age of the fleet, total deadweight, which is the cargo transporting capacity of the fleet, close to 2 million tons. Moving on to the next slide, slide number 6, this is a brief history of the company. As I mentioned before, we have been listed since 2008 on Nasdaq. The phase one of the company between 2007 and 2014 was a whole different company. I personally joined Seanergy in 2012, and we led a very successful financial restructuring that we effectively rebuilt the company from the beginning, and we invested into what we believe to be the most hopefully soon, the most profitable segment in the dry bulk space. I'm not going to focus in the previous 5 years. I'm just going to focus on what we did last year in 2020, where we effectively overhauled our balance sheet. We raised a significant amount of equity capital from the public markets through institutional investors altogether with a high demand in the company's stock. We have restructured close to $180 million of our secured facilities, secured and junior facilities. We have acquired one more Capesize vessel at one of the lowest values paid in history, and we have increased the period of employment of our fleet quite significantly. Right now, I think we are and as I mentioned before, we are in one of the most advantageous positions to benefit from a very rising market in the dry bulk space, and especially on the Capesize. Moving on to the next slide. Myself, I have more than 20 years of experience in shipping and finance. Stavros has more than 14 years experience in banking and shipping finance as well. And we have a high-quality board of directors, 5 members altogether, 3 truly independent, highly experienced professionals. Moving on to slide number 9, a little bit of name dropping here. This slide presents the key commercial relationships of the company. As you can see, we only do business with some of the world's largest dry bulk miners and vessel operators, and we have established joint ventures and partnerships with some of these names as well that I will explain in a minute. Seanergy is considered to be one of the top and most prominent Capesize vessel owners for these huge names to do business with. Moving on to the next slide. That slide presents almost 60% of our fleet is in joint ventures and partnerships with some of the names that I mentioned before. And these are Cargill, Uniper, which is a major European utilities company, and Glencore, which is one of the world's largest commodities traders. They have invested on our ships and they have invested in the company, and they have effectively increased the net asset value of the company with their investments by installing energy-saving devices and scrubber, exhaust gas scrubber devices on our ships. The total investment last year in the company in 2019 and 2020 has been in excess of $22-23 million that has increased the value of the vessels. One of the deals we did with Cargill, that is a synthetic lease, a sale and lease back, was considered by a prominent publication called Marine Money to be the deal of the year in 2018 in its innovation and various other financial and environmental targets. Moving on to the next slide, slide 11. That slide is actually going to be discussed by Stavros later in the presentation, so I'm going to skip that for now. And I will now move into the analysis of the market fundamentals and why we strongly believe that the market is going to be very, very strong for the next years to come. If you see here in slide number 13, there is a very high degree of volatility historically in the Capesize segment. For reasons that are kind of self-evident, we have cut the top premium that the market experienced between 2003 and 2008, because at that time the market went up to levels of $150,000 to $200,000 per ship per day. So these are numbers that we don't think are comparable with super cycle at today's levels. But if you focus into the bottom part of the slide, which is right here, the last 6 years, 5 years, and 2021 is not so comparable, you will see that there is a strong upward trend into the market. So the bottom part of this slide is magnified, that part of the upper side of the graph. 2021 has started very, very strong. So we have had the strongest start of a year, not just in the last 5 years, but pretty much in the last 10 years or so. And that is attributed to a number of reasons. First of all, demand for transportation of raw materials such as iron ore and coal has been one of the strongest in recent history. That is evident from the price of iron ore that has now exceeded $170 per ton. That's one of the highest historical levels of iron ore. So that shows how strong the demand is. And the reason why the demand is so strong is as the world is exiting from the global pandemic of the COVID-19, there's going to be trillions of dollars of infrastructure investments happening in various parts of the world, mainly in China, but also in the US has been announced that there will be trillions of dollars of infrastructure investments as well. So we expect steel and iron ore and metallurgical coal and thermal coal to continue to be very strong in respect of transportation, and that is going to continue driving the rates upwards back to the historical average, which, as you can see here, is around $27,000 per day. Staying on this slide a little bit, another important point is that while demand for transportation of iron ore and coal continues to be quite strong, the supply of new ships is at one of its lowest points over the last 15 years. The reason why the supply of ships is quite low is pretty much because the new environmental rules that have been introduced and going to be in effect, pretty soon, in 2030, are not clear as to what the vessel of tomorrow is going to look like. So nobody in its right mind is now rushing to make new building orders of ships without knowing what is going to be the ship of tomorrow. So a vessel that is going to be delivered in 2023 or 2025 might actually be redundant in 2030. So that prohibits people from going out and rushing into new buildings. So with a very given amount of vessel supply right now into the market and the rising demand, we see that the rates are actually moving towards the historical averages, which is $27,400 a day, and that we think might be quite sustainable in the next years to come. Moving on into the next slide, slide number 14. What we see here is where we stand into the historical perspective of the Capesize. So even though the market has increased quite substantially as compared to the previous year, and we have started with 2021 at one of its highest levels, you can still see that we are quite far off from the long-term averages. So as you can see, a 5-year-old Capesize, which right now stands at around $26.7 million, it's still almost half the value of the 15-year historical average. That being said, the same stands for the rates. We expect that to start moving towards the historical averages, and that means that a company like Seanergy will benefit substantially, and our shareholders will benefit substantially from this increase in rates. Before I jump into the financials, and Stavros can give you a quick overview of the debt position and the summary financials, I need to say that being into the Capesize market actually has the strongest possible upside in a rising market environment. The Capesize rates have always outperformed all the other asset classes in the dry bulk. So, being 100% focused on the Capesizes, we expect that to be fully reflected into the cash flow, into the EBITDA, and of course into the returns that we're going to generate for our shareholders. Having said all that, I will now pass the floor to Stavros, our CFO, and he will discuss very briefly about the financials and the debt position of the company.
So thank you very much, Stamatis. So a very warm welcome also from my side, ladies and gentlemen. It is good to be presenting at the Noble Conference this year, whereby our market is in the spotlight, and especially after last year, whereby we were promised light at the end of the tunnel, but COVID turned the light off. But 2020 has been a transformational year for Seanergy in many respects. As Stamatis said before, in the first half of the year, we were very busy on the equity front, whereby we raised around 75 million of fresh equity, which was basically put at work in the second half of the year by assisting us to complete our corporate financial restructuring. That amounted at around 108 million in refinancings and new facilities. And Seanergy emerged in all respects as a stronger company with a very robust financial footing for the years to come. So as part of this restructuring, we have successfully addressed around 90 million of maturities which were falling due in 2020. These were extended to future dates between December 2022 and December 2024, providing the company with a clean 2-year runway with no significant maturities for the next 2 years. We managed to reduce our interest expense and repayment installments, which will have an immediate positive effect on the cash break-even of our fleet. And we managed to enhance our financial flexibility through various structural improvements on our loans. Now, how our debt is looking today. This slide summarizes our facilities. I don't know how familiar you are with ship financing, but usually vessels are financed through amortizing credit facilities, such as the ones that are reflected in the 4 first rows of the table. And these are, in our case, provided by very experienced ship financiers, such as Alpha Bank out of Greece, one of the 4 systemic banks in Greece, Amsterdam Trade Bank, a specialized ship financier out of the Netherlands, UniCredit from Germany, and Entrust Global, a US credit fund, which also specializes in ship financing. In the following 2 rows, we have a relatively new product which is becoming very prominent and very popular in ship financing. These are financial leases. In our case, we have concluded one with AVIC, which is a Chinese state-backed lessor, and with Cargill, the very well-known charterer in our space. In the last row, we have three junior facilities provided by Zelco Delta Holding, a family office which used to be an affiliate of the company, and through our restructuring, we have basically terminated such affiliation. Very quickly, we will move to our capitalization overview. Long-term debt has seen an impressive reduction in 2020 from 207 million at the end of 2019 down to 170 million, 36 million reduction, which is around 17% of our debt. This was achieved in 1 year, increasing the potential of the company enormously. Now, shareholders' equity equally has seen an impressive increase from close to 30 million at the end of last year to almost 87 million this year. An overview of the basic market capitalization of the company, close to 70 million today. As Stamatis said before, our ticker on Nasdaq is SHIP, and you should please watch this space because there is much more to come. I will not bore you with more financial figures right now. I mean, we should conclude the presentation now, and we are happy to answer any questions that you may have. Paul, over to you.
Thank you, Stamatis, and thank you, Stavros. My name is Fratt, and I'm the analyst at Noble Capital Markets, who covers Seanergy Maritime. I have close to 30 years of experience both on the buy side and sell side covering energy-related and offshore industries. So it's a pleasure to cover Seanergy Maritime. Stamatis, would you talk about demand for the Capes? You talked about the longer-term positives that you see on most of the segments, and the one concern that we often get is the question is the demand over the longer term with thermal coal. Essentially with emission standards, or carbon emission standards likely to be more and more restrictive over time. Can you just talk about, one, the impact potentially that you might see if thermal coal does decline, and then maybe quantify the overall, market share that thermal coal represents?
Of course. Thank you, Paul. And, to everyone, Paul is the actual star of today's presentation. So nice to see you again, Paul. Well, that's a very interesting question. As I mentioned before, our ships transport mainly iron ore and coal. Now, our coal is basically two different types. The first one is the so-called metallurgical coal, which is used together with iron ore for the production of steel. And the second one is the thermal coal, which is used by various countries for the production of energy. Indeed, there has been a reduction in the transportation of thermal coal, and it has been quite significant in the previous years. However, this year, the energy needs of most of the northern hemisphere and the very severe and rough weather conditions that a lot of countries have sustained has actually driven up the demand and transportation of thermal coal. But in our opinion, we do not really depend on thermal coal so much. We're not so dependent on thermal coal. We mostly do iron ore and we do metallurgical coal. And we also see bauxite, which is a very important commodity that is in slow rise right now, which in our opinion is going to compensate for any loss of the thermal coal into the future. However, please have in mind, Paul, that what is going to drive the Capesize rates into the future, aside from the supply of ships, is the demand for higher quality iron ore. Given that all of the countries are imposing tougher and tougher conditions on environmental emissions, a higher grade of iron ore, which is basically produced in Brazil, generates and produces steel with a much lower emission than the lesser quality of iron ore. Brazil to China is 3 times the trip as compared to Australia. So the more cargo that you see out of Brazil even if the actual imports from China remain the same, the substitution effect is going to have 3 times the ton-mile effect. So that's going to drive rates upwards. Brazil in 2019 and especially in 2020 had, for various reasons, one of the lowest outputs of the last 5 years. Unfortunately, Brazil exported in 2020 something in the region of 330 million tons versus a total of around 380, 390 a few years ago. And that is expected to be compensated soon by various reasons that we think will start to happen. So we think that Brazil is going to move towards their natural production rate in the next few years, and that longer ton-mile transportation and ton-mile demand is going to help drive freight rates upwards significantly.
Great. Yeah, it should be, the other sectors and secular growth should more than offset any potential loss of thermal coal demand. Thermal coal demand, as I estimate it, Stamatis is probably, 5% of the overall market, and it's not going to go away right away. In fact, it probably will be more flat than people think. Can we look at, the year and how the year is starting off? Others have highlighted, and I think you've talked about that we're going into the year, at least in January, higher than at least the last 2 years. We haven't had a black swan event yet, fortunately.
Yeah.
Can you talk about just the factors that are pushing rates up earlier than expected, and whether you think we, from a standpoint of, is there not going to be a Chinese New Year effect this year, and sort of what you're looking at for the next couple months and how much visibility you have?
Yes. Well, the reason why we see this squeeze into the beginning of 2021 is the weather effect. I mean, we have had one of the coldest winters in the recent history. So a lot of countries in the northern hemisphere have been frozen, and there are a lot of ships that have been trapped in various frozen places, and the demand for thermal coal in order to compensate for increased natural gas prices and the increased energy needs of these countries, to warm up basically, is quite strong. So that very strong beginning of 2021 was fueled for reasons that are not so much related to iron ore, but are mostly vessel supply. There are certain vessel supply restrictions, as well as the thermal coal that we were discussing before. So if we have a quite strong Q1, as it appears, one of the strongest in recent history, and God forbid there's no other black swan event, I think that 2021, it appears to be a quite, we're very optimistic about 2021 as far as the year is concerned for the rates.
Yeah, likewise, we think it's finally the year where supply and demand fundamentals, finally take hold, and, the low order book and, the aging of the fleet will be a positive, looking at even this year and next year. Stamatis, you talked about the operating leverage that you have, that, at 10-year rates and, historic rates, you generate much higher operating cash flow. Can you highlight how you plan to, if rates do either stay high or move up, how you plan to capture that? Your contracts are mostly indexed now, so you will benefit from higher rates, but how do you create a sustained, how do you capture that high sustained operating cash flow on a sustained basis?
Yeah. Well, we feel that there will be some period employment opportunities for the company that will present themselves towards the second half of 2021. What I forgot to mention before, which is actually a very significant element that is going to help rates, move up even further, is the fact that the new environmental regulations that are kicking in from 2022 and especially in 2023 will require for the existing fleet to slow down in order to meet these regulations. So the actual emissions that, the CO2 emissions that the fleet, the global fleet, will need to produce will have to be reduced on a year-by-year basis by a certain given amount of reduction, which means that in order to meet that target, the global fleet will have to start slowing down. Slowing down the fleet means that, for every nautical mile reduction of speed, that is actually a very significant impact on the supply of vessels. And that is going to create another supply deficit or a squeeze, if you want it, into the rate. So a combination of a healthy demand together with declining supply of ships, not just being stable at all these levels, is going to, to make rates go much higher. Our opinion is that period opportunities will start presenting themselves into the second half of 2021 because the major charters will realize that it's going to be impossible to cover their export schedule and levels without having a secured number and level of ships and of course rates. As far as Seanergy is concerned, notwithstanding the fact that we will be seeking to start fixing part of the fleet in a period of employment, we expect to do some smart chartering these years with the flexibility of the index link that we can switch into a fixed rate, which is embedded in most of our period employment contracts. So our period employment contracts on a lot of our ships allows us to be able to convert floating to fixed in order to capture what we believe to be a high degree of a certain vessel rate.
Okay, perfect. And then can you highlight, the last year we've had to, or last sort of 18 months or 2 years, we've had to contend with, IMO 2020. Can you talk about your strategy with, moving past IMO 2020, how you viewed scrubbers and how you minimize the cost to Seanergy of those scrubber installations?
Yes. Well, we were one of the pioneers in start investigating the impact of the IMO 2020 back in 2016 and 17, when in combination with the American Bureau of Shipping, we did a feasibility study. It was, of course, impossible to predict not only where the fuel spread was going to go, but also the black swan event of, the COVID-19 and all this impact into the fuel prices. So in order not to take a position on the fuel, because we don't really believe that a company like Seanergy has, as a shipping company, has the ability to predict the oil market, we decided to participate into the IMO 2020 environmental compliance by sharing the cost with our charters. Actually, the charters paid up for all the environmental costs, and we did that in some sort of a joint venture and partnership with them. So they invested in the company and they paid for the environmental compliance with IMO 2020. So all the scrubber investment in Seanergy has been fully paid by our charters. We did not take a position, for or against the scrubbers. We wanted to be a pass-through. However, what we managed to do is that we also put a profit-sharing element, which means that if the fuel spread exceeds a certain threshold, then we start sharing the profit with the charters. And the residual value of all this investment after 3 to 5 years from the installation in 2019 and 2020 is going to remain with Seanergy. So in our opinion, it's a win-win situation. We didn't want to gamble or bet something which is not relevant to our day-to-day business, which is transporting iron ore and coal. I don't think it's in our place or position to be betting with fuel spreads. It's not our day-to-day business, as I mentioned before. So we did it in one of the smartest ways that has happened in the shipping industry.
Great. And Stavros, you were a busy man last year and even earlier this year. Congratulations on all the refinancings you were able to complete, and extending that amortization fairway and maturity fairway out to give us a little breathing room. Can you talk about how your banks were approaching the refinancing, and whether what they're sort of telling you about the potential their loan activities or financing activities with within the shipping industry?
Thank you, Paul. First of all, it was an effort by all of us in Seanergy, and Stamatis' contribution also to that, was pivotal, I would say. With most of our banks, we have very long-standing relationships, and we have supported them, and they have supported us through very challenging years. The fact that we were able, and we were proactive in raising equity, and we were able to support this refinancing in the second part of the year, at the same time when the banks were facing huge issues with borrowers that were under pressure due to COVID and were not able to make their repayments, were not able to put out prominent terms for the restructuring of the loans. That helped a lot in Seanergy's, in what we did in Seanergy. At the same time, having had the relationship with these lenders for the last 5 years and having seen what Seanergy has achieved following its relaunching in 2015, they were comfortable in extending their balloons for a number of years. So overall, I think that the backing of the lenders has been very strong and is still there. Some of the legacy lenders which were not able, due to their own reasons, to continue the relationship, were restructured through new lenders which wanted to enter the company, wanted to increase their position in Seanergy, which is also a very positive signal. And we were able actually to refinance the loans at discounts, which had a direct reflection on our balance sheet.
Great. And, you were able also to, take care of everything. It was almost a global financing. Can you talk about, the reemergence as Jelco Delta Holdings as, an equity holder, and maybe in the context of looking at that hard cap of 9.99% and how that mechanism works to limit the amount of overhang that you might see? Will they have to sell shares in order to execute additional warrants, and maybe, if the stock moves high enough to convert that debt that's still outstanding? Can you just help me understand how that mechanism works?
It's very important. When we're talking about Jelco, it's very important to have in mind that Jelco has been very supportive historically to the company. We have gone a very long way with Jelco, and it's the success of Jelco's investment and also the success of the debt capital that is in Seanergy is tied with the success of the company. So Jelco wants to approach very carefully, their investment in Seanergy going forward. Indeed, there are very hard blockers which limit Jelco's shareholding below 10%. And Jelco indeed will have to trade out of the stocks in order to exercise warrants or to exercise any of the convertible notes. In doing so, of course, Jelco has stated repeatedly that their intention is not to do undisciplined sales of the stock and bring the share stock down. They will be very disciplined in their approach. They want to see the payback in their investment in their loans, but always in a very disciplined manner and in the passage of time. And while Seanergy will also be, Seanergy share will also be increasing and improving. So you will not see a phenomenon whereby you will have massive sale of shares from Jelco. Everything will be done in a very disciplined and structured way.
And if I may add on Stavros' point, it's a matter of governance. Jelco was a previous related party to the company. So in order for us to decharacterize, a previous related party, it's very important to set very strict rules so they can trade their shares without, any downside risk or any governance risk to the company. So the blockers are actually a very smart way that has been introduced into all kinds of offerings by the underwriters that avoid any independence issues that may arise from increasing stakes above 10%, especially with the next related party and a previous controlling shareholder. It's very important from a governance point of view to have the right blockers and the right discipline in the way that this investment is being exited.
Great. And just two sort of other questions about just shareholders. One is that, with all the restructuring, Stavros and Stamatis, I noticed that you do have the ability to pay a dividend and do other things to benefit shareholders. Can you give us just your view on that at this point in time? And then secondly, can you update us on the timing of any compliance issues with the $1 closing bid price? And just, when if you do need to make that decision, when would you have to?
Yes. As far as dividends and shareholder returns, this is a top priority for us. As I mentioned in previous statements, we do not expect and we do not want to do another equity offering. So, we don't want to dilute the shareholders of the company, and we have pledged personally to invest in the company, and I have done so very much as a vote of confidence in how I believe into the equity value of the company to be quite significant. Dividend is, of course, one of our top priorities. We're just exiting one of the worst years in the recent history. The fundamentals and the outlook are very, very positive. We just need a little bit of stability before we declare something, in order for that to be on a sustainable manner. So this is very important for us. Again, it's a top priority to start generating returns for shareholders, and that can come in multiple ways. Dividends also a top priority. We just need some stability first and some, sustainability before we start making any long-term commitments for shareholders, because we want to be in a position to meet these commitments no matter what. As far as the Nasdaq compliance is concerned, we have until March. The stock price has been performing quite well. We can request, and we will likely be granted another 6 months by Nasdaq. So we will do our best, and we will put our best efforts in order to avoid any reverse stock splits or something like that is going to decrease the value of the shares. Actually increase the value of the shares in a technical way. So we'll try to avoid that. The stock has been going quite well. We were at 40 cents a few weeks ago. Now we're trading at above 80 cents, I think, right now. So, we have done an excellent performance. And once the investment community is going to realize where the company is heading and what are the real possibilities and potential of the company, I think we'll likely see that reflected in the stock price even more.
Well, wonderful. I think I want to thank you, Stamatis and Stavros, for participating. I think we've covered a lot of ground. Thank you for not only a thorough presentation and an overview of not only the macro environment, but also the micro environment, and also a healthy Q&A. And I think we've covered all the questions that came in from the audience. So thank you so much, and I really appreciate you participating in NobleCon17.
Thank you.
Look forward to seeing what the rest of 2021 holds.
Yes, we hope to be together in the next Noble conference, hopefully next year in person, not through a camera.